Okay, here we go. So thank you guys for coming on today to learn about this really great new product called DSCR. It is a loan that is strictly for investors. It cannot be used for anything other than investment properties. And the main condition of this loan is that whoever uses this loan, they have to own a current home. So they can't be a first-time investor with no housing mortgage history. So I'm going to go ahead and share my screen with you. I'll put together a little PowerPoint. Hopefully this works. Okay, and I'm going to hit play here. Okay, can you see that?
Yep.
Great. Hey, look at that. Center stage, the DSCR investor loan. All right. So what is DSCR? DSCR stands for debt service coverage ratio. And it's specifically for really for the investors that have a very high debt to income ratio, or which is usually results from having a low net self-employment income, or they have multiple investment properties, or their main source of income might be for investment properties, but they don't make enough to, or they don't show enough after write-offs to be able to purchase another investment property. So that's the purpose of this loan type. And there's some eligible sets of people. They either have to be a U.S. citizen or they can be a permanent resident alien. And as I discussed before, they do have to currently own a home and have mortgage history. Who is ineligible? Non-permanent residents, first-time home buyers, and non-arm's length transactions between family members, which means it can't be used for someone buying a property from another family member. So there's some different products. They have, of course, the fully amortized products, which are non-interest only, and they have interest only products for 30 and 40-year terms. Of course, when you start going into a 40-year or an interest only product, the rate is always going to be higher. And when you're doing specifically an interest only product, there's going to be a time where that loan is interest only, and then there's going to be the repayment period, which usually the interest only is going to be 10 years, and then the repayment period is going to be the remaining years on that loan, either 30 or 40 years, and that loan will recast to whatever the balance currently is over the remaining set of years. So interest only is good as far as getting the payment low enough to match the DSCR ratio, which I'm going to explain in a little bit. But it is available. And like I said, of course, the longer you go, or when you start adding interest only on, then the rate goes up as well. So the DCR or DSCR, I'm sorry, is the ratio of operating income available to debt servicing for the principal, interest, taxes, insurance, and HOA fee payment, which is PITIA. A stands for association dues. The interest only product specifically, they calculate that by taking 100% of the gross rent and divide that by the interest only, taxes, insurance, and any association dues if it's in a condo or PUD, and they divide it by that. So the ratio requirements for this loan. So for a purchase and a rate and term refinance, it has to be 1%. So what does that mean? So what that means is they're going to be qualified just based on this ratio. So for instance, let's say someone's buying a house and they're putting their money down, and the loan amount is going to be 250,000, and that payment is going to be let's just say it's going to be 2,200. The fair market value for rent for that house has to be 2,200 or higher. If it is, then they're eligible for the loan. So that's basically the way that this loan works is it works on ratios. If someone has a 720 credit score and they put 30% down, they can actually go down to 0.8. This loan does require a minimum of 20% down. And of course, there's no mortgage insurance because of that. But like I said, if they have a 720 credit score or put 30% down, then they can get a 0.8. If they're doing the 0.8, they do have to have an additional 6 months of reserves. No mortgage lates on their current mortgage. If they wanted to do a refinance, they're going to be looking at 1.15. So of course, it's going to be a little bit higher for cash out. And they can be a first-time investor. Now, remember I said you can't be a first-time home buyer, but you can be a first-time investor. So for someone that is diving into investment properties for the first time, they can do that, but the ratio has to be at 1.25. So if someone had a $2,000 mortgage payment, the fair market rent value has to be at least $2,500 for that to take place. So you're probably wondering, well, how do they get the fair market value? So that's going to be the upfront. So if you have a client that wants to use this program and they want to put an offer in, you'll have to do your research as far as what the market rents are going for. Of course, you could always find out, or they can always find out when they get their appraisal because it'll be listed on there. But then you're risking the loan not to go through. So you want to do as much upfront as you can on a property that they'd want to write an offer on. And you could do that by either reaching out to an appraiser, asking them what they think they could get for that, or just doing research from probably MRIS to figure out what the fair market value for rent would be for that property. If you see that it's not going to come in or their payment is going to be too high, then you know it's not going to go through. So on this loan type, there is going to be a little more upfront research and work to be done. But again, it's a great program for the people that may not qualify based on the debt to income. And then lastly is the condo tel, which we don't have any of those here. But if someone was purchasing maybe in your Myrtle Beach or possibly in North Carolina, maybe out in Topsail or possibly the Outer Banks, we can do the condo tel as well. And that's a very difficult loan or product to find. A lot of investors don't do that loan. So this is another available product for that for the investment properties. Some guideline requirements: minimum loan amount of 100,000. So if someone's buying a $400,000 house, they can't put down more than 300,000. The maximum loan amount is 2 million, and remember that's loan amount. So if they're putting 20% down, right there you're at about 2.5 million, I believe, if that math checks out, that they could for the purchase price. The different eligible property types are 1 to 4 units, and that's up to 20 acres max. So of course, that could be a townhome, or a single family or a modular. Condos, warrantable and non-warrantable. And a non-warrantable condo, we don't have a lot in this region, but it's something that doesn't meet a normal Fannie Mae and Freddie Mac requirement, such as investor concentration. That's a big one. So if you have a project that has over 50% concentration of investors, Fannie Mae and Freddie Mac won't do that loan. But here on this product, we can do it. Of course, like I mentioned before, we can do condo tels and leasehold. So that if somebody is would own the property, but it's on a leasehold, meaning they're paying lot rent, they can actually do the loan as well on that. And of course, like I said, modular homes are eligible. And then property unit development. So any kind of HOA or PUD, as they call it, you can do a DSCR loan in those areas. Some more guidelines. Again, the eligible bars are U.S. citizens and permanent resident aliens, which would be a green card. A work visa is not considered a permanent resident alien. They have to have at least a green card. Now, here's some guidelines for the first-time investor, as I just talked about. So someone who owns a home but wants to get into the investing arena, they need to have the following. They have to have a minimum of a 700 credit score. They have to put down 25%. So whereas an investor that has other investment properties only has to put 20% down, they have to put 25%. They have to have owned their primary residence for 12 months. They have to have a positive 12-month history, meaning no mortgage lates. And then they have to have a 36-month history of credit. Oops, sorry about that. Hit forward too fast. And then the other one was they had to have 1.25 ratio. The seller may pay up to 2% in closing costs, which is awesome. You normally, typically on this kind of loan, the sellers would not be able to pay any closing costs, but for this loan program, they can pay up to 2%. As always, with a risky product like that, reserves are a big thing. So if you notice that this loan is it's really all about assets and credit score. So if you're doing a loan, or if a person is doing a loan that's under 1 million, they do have to have 6 months of that payment in reserves. If they're going over 1 million, they have to have 9 months of that payment. Also, in addition to that, they have to have 2 months of the PITI payment for each additional property. So let's say someone owned 4 properties and they had mortgages on all 4. You'd have to take the mortgage payments, add them up, divide that by 2, and then add that on to whether it's the 6 months to the 9 months. So they do have to have all of that cash on hand or assets that can be liquidated. Employment income not reported. So this is kind of almost like it's not a no doc because they have to show all the assets, but it's almost kind of like a stated assets, no stated income. So they used to call it what, NISA, no income stated assets. This brings me back to those early 2000s when all those crazy products were out there. The difference now, though, is there's a substantial amount of skin in the game, which minimum of 20%. Back then, they were letting people do these loans at up to 100% financing, which is kind of what destroyed the entire market. And then the other cool thing about this is they can own an unlimited number of properties. Now, for their application, they're going to have to type all the properties in, what they owe on them, what the values are. But as Fannie Mae and Freddie Mac, you're limited to 10 investment properties total. This one, so if somebody hit that number and they still want to continue to buy investment properties, they can do that with this loan. And then finally, the appraisal. So if it's a loan amount of under $1 million, they just need 1 appraisal. But if it's over $1 million, then they have to get 2 appraisals. And of course, we order those appraisals. We have to do it where it's 2 completely separate companies doing those appraisals, just to make sure that they're valid and have 2 sets of eyes. That's pretty much it about this this loan program. Again, it's for the investor. Here we go. It's really for the investor that's seasoned. But if you do have that home buyer that wants to get into investing and they just can't show the income from either too much debt or not enough income or too many investment properties, whatever it is, this is a great product for them to have. One thing I did not put on there was rates. The rates vary, as I said before, depending on the term, if it's interest only or not. And then there's one other factor. There's 3 choices that they have. They can choose a no prepayment penalty. They can choose a 1-year prepayment penalty, and they can choose a 2-year prepayment penalty. And the prepayment penalties are generally going to be a percentage of the loan amount, where if they pay it off within that amount of time, they have to pay a penalty. And those, of course, go with the rates. So if somebody chooses a no prepayment penalty, then the rate's going to be higher. If they're going to keep that loan for 1 or 2 years minimum, then the rate's going to be lower, because that way the investor is going to make money. So if someone was specifically going to use this for flipping, obviously they're going to want to do the no prepayment penalty, take the higher rate. But if you think about it, it really doesn't matter, because they're probably only going to have to make maybe 3 or 4 payments on it anyway. But I did look up the rates, and for someone, if they were doing the 30-year fixed on the property, it looks like it's probably going to be in the high 9s to like mid 10s, depending on their credit score. And I know that sounds insane, but again, if you think of the risk that's involved with the investor, I mean, that's, when you're not counting somebody's income and you're only strictly going by assets and the DSCR ratio, that's a big risk. So if someone did purchase the property using this loan, and they're not flipping a property and they're going to hold it, of course, obviously in the future, they can refinance it, and they can refinance it with a traditional, as long as they're showing the income. Let's say somebody had a newer business, and they wanted to invest in properties, but they haven't shown enough income, or they're in the first 5 years, and they're building their business. Down the road, they can always refinance out of it. But again, it's a really great product for the people that want to get into investing, that don't have the income, but have the assets. Generally, it doesn't go hand in hand, but you never know. People do inherit money. They inherit homes. They inherit land. They have parents who may pass away. They may have a really big 401k that they can draw from. They may hit the lottery. I don't know. But if anyone has any questions, feel free to either put it in the chat or just ask me here, and I'll do my best to answer for you.
If they do inherit, Mac, and say the property's been rented and the family inherits and whatever, they decide to keep it as a rental, they can't refinance out with this loan. This is not a cash out
Actually,
loan.
they could. Actually, they could,
Okay.
as long as they own a property and they've owned it for 12 months and made payments, they could actually do a cash out on it. Now, of course, that rate's going to be pretty high, but if let's say they wanted to do a cash out and maybe renovate it and then sell it, they could absolutely do that.
Okay, that's good to know.
Yeah.
And what if it's inherited, so they've only had it, you mean owned by the owner for 12 months, or what if it's an heir and they've only had it, for 3 months?
Yeah, they can still do that. It's the time is on their current property that they have to have owned for 12 months.
Got it. That's right.
One, yeah, on that one, there's no restriction as far as time goes to do that cash out. And when you
they inherit,
go ahead.
sorry, they inherit, and then they want the cash out to fix it, and they want to sell it because it's a good market. They can do that with this program at a high rate based on
Yeah, and on something like that, they'd probably want to do an interest only and no prepayment penalty. That's probably going to be a 12, 13% rate. I don't know, but again, they're only paying interest only while they're doing whatever they need to do. So it's probably not going to kill them as far as the payment goes. But it's a great way to it's kind of almost free money if you think about it.
It is it's almost like a hard money-ish type thing.
It really is.
You're going to do it for a short term.
Yeah. Okay. Yeah.
How long do you take to turn these around? Is it about the same as a homeowner type loan, or?
Yeah, it's going to be the same time. Now, on this loan type, it's not an automated underwriting; it's all manually underwritten. But if you think about it, most of the things that you're going to have your problem with underwriting is the income or the debt to income. Well, because there is none of that, the only real time is figuring out what's the DSCR ratio going to be. And, depending on how long it takes the agent to figure out what's the income rental market for this house versus what's that payment going to be, that's pretty much it. But a lot of that's going to be upfront. Now, if you saw a house today and it's got 15 offers on it, the chances of you probably getting that information back in time to be able to put an offer in, that's probably slim to none. But the other cool thing about it is because they are putting a minimum of 20% down, 20 to 25 to 30 or whatever they want, it's going to be an attractive loan program. And the fact that there's no the seller doesn't have to worry about debt to income issues or income issues or anything like that, they're fine. Or even employment, that's not listed on the application. So so really it's going to be that that buyer says, man, I really like this house, and Jane says, okay, great, let me get on MRIS real quick and see what this rental income is, and okay, now call Mac and figure out what would that payment be, how can we get that payment down to 1% of what this fair market rent would be. And that's where I would come in, is
All right.
okay, trying to match them up with whatever product would get that payment down.
And then you have appraisals. So
Exactly. And then the appraisal is going to have to, obviously match that. But, generally, if you're getting it off of MRIS, it's going to be this, the appraiser is going to get the exact same information.
Yep. That sounds great.
Yeah, I mean, it's almost kind of one of those too good to be true loans, but it's the new hot thing out there right now. And the biggest problem with most investors to go through Fannie Mae or Freddie Mac is debt to income. And as you start accumulating those properties, and any good investor or any good business person, you're not doing your taxes for your mortgage, you're doing them for business, right? Which means a lot of people write a lot of stuff off. So they're writing all the repairs off on these properties. They're depreciating it. They got their taxes and their insurance they're writing off. Renovations, they're writing all that stuff off. So the true income isn't showing. They might be renting a place out for 2,500, but after the taxes, they could have a loss, or maybe they're only really getting 200. And you start adding that up versus their debt, it just doesn't work. So this is a great, like I said, a great alternative to any of those Fannie Mae or Freddie Mac products. And the biggest thing really though is there's no property number. They can keep buying and keep buying.
I
And
didn't know that. That's interesting.
Yeah. So
Who
there's
generates
nothing.
this loan? Is this a government loan?
No. This is this is going to be what they call a portfolio or private investor loan. So it's going to be different banks or different investors that offer this. So they're going to use, it's going to be their own money that they're putting in, or they may take the loan and package it to an investor on the secondary market that'll purchase the loan. And when you've got that kind of skin in the game, their whole thinking is, okay, well, we're going to make a ton of interest, right, off this product. So we're going to make money as long as they have it for a little while. If they don't do the prepayment, we're going to charge them more. And then if they do keep the loan, that's a lot of interest that they're making on it. So and if the person decides not to pay, guess what? They turn around and sell it, and they're going to get their money back. Plus, they got equity. So it's a as risky it is, it's not risky.
Well, I mean, and I didn't realize, that's a fund. It's an investor.
Exactly.
Yep.
And generally when you have
it's within your mortgage company, or is it just
no. So we actually are a correspondent lender for this product. So I was mentioning before, we don't underwrite this loan. It actually goes through the investor themselves. They're called New Res. They've been around for a while. They used to be more in the servicing, but now they've ventured out into some what they call the non-QM loans, which are non-qualified mortgages, which are anything that's not Freddie, Fannie, or government.
Okay.
So they're going to be the ones to underwrite it. Again, it's really not much to underwrite other than the ratio and getting the appraisal and the value, the DSCR ratio. So,
and then just understanding the investor has the money to put down, because that's the only other problem they would have. You have to have some cash. So
exactly, you got to have the cash, and you got to have the reserves. Um,
You're gonna be looking to see where that cash came from, like, a regular loan, or is it, do they can't borrow that cash?
no, it's got to be their own funds. So now, like I said, if they had a TSP, 401k, IRA, anything like that, that they can cash out, that's eligible money because
Okay,
it's secured.
okay.
They can't get gifts. They
Okay,
can't take out a personal loan. Um, they could take out a HELOC because that's secured on their primary
yep,
residence. So, but again, the key is having the reserves and then having that down payment. And Jane, typically when most of the time, most investors have really good credit, and most investors usually have the money, especially a lot of them that are flipping. Every time they flip, they if they don't put it in a 1031 exchange and they're taking that money and putting it in the bank, they grow their assets.
right.
I actually have some investors that own 10 properties. I think 8 of them are financed, but they did a round one time. I literally refinanced every single property as a cash out to the max that you could go to. And they probably have over $500,000 in the bank from all that, and they're taking that money, they're making interest on it. Of course, they're making the monthly payments, but their cash flow is paying for that. And
Yep,
now, if they want to go buy more investment properties, they can do that, and they've got the cash to put down, and they've got reserves.
leverage,
Really
yep,
smart.
that's awesome, yep,
Yeah.
it's,
So if you know anybody that wants to get into investing, um, and uh, they they can't qualify due to debt to income or self-employed, this will help them as long as they've got the cash.
yeah, this is great, Mac, because, I don't think this topic's come up a lot, especially in a webinar or whatever. Um, for realtors, it's for anybody, but, to know how to talk to them, so.
Yeah, and it's a relatively new product. It's not brand new, but it's kind of starting to come out on the forefront now. Um, a lot of You're not going to see your big banks carrying this loan, just too much risk. Um, you're mostly going to find either brokers doing them or correspondent lenders. But even then, it's for the original lender, the originating lender, there is some risk because something happens and there's a buyback, you have to take it back. So, um, hence why our credit score requirements are probably a little bit higher. I mean, I've seen some places could have down as low as 660. But again, you got to
Well, the
lower
loan to value too is 75% is, that's a lot less,
right.
you've
Exactly.
all put some money in the game, yep.
Exactly. That's the key. So, um, any other questions, Taylor? Anything? All right. Well, if you have any other questions, just feel free to hit me up offline, and or if and if there's anything I don't know, I can always look it up for you. But please
Okay,
share this with anyone that's in your office that may be interested. Like I said, I recorded this so I can just send them the link. And I
all right,
really appreciate your time today. Thank you so much, and I look forward to helping you guys out.
all right, see you later,
All right. Have a great day.
bye.